Thank you very much, JJ. Thank you, Noel, for this kind invitation, which, Noel reminds me, was made exactly a year ago today. Now, granted, it was at lunchtime, and this is a dinner speech, but that's the forward planning there. Thank you, Kathy, for coming, and may I also acknowledge Dan Sullivan, our Counsel General here, Canada's Counsel General here in New York. Dan, thanks for being here. I thought I wouldn't talk about Canada. I'll sneak in a little bit about Canada in the speech later on. But in the spirit of the Foreign Policy Association and in the spirit of the times, I thought I would speak more about the international monetary system, as JJ indicated. And I'll start by saying that in response to what I think we all acknowledge has been the worst financial crisis since the 1930s, policymakers around the globe, and virtually without exception around the globe, have provided unprecedented stimulus to support recovery. Policymakers are pursuing a radical, and in fairness, they are a radical set of reforms to build a more resilient financial system. But it's not clear that even this heavy agenda will be enough to secure strong, sustainable, and balanced growth over the medium term. And I think we all must consider whether to reform the basic framework that underpins global commerce, that is the international monetary system. And so my purpose this evening is to help focus that debate. It's a debate that has begun on the international monetary system. I'm going to try to focus it a bit. There were many causes of this crisis, but its intensity and scope reflected unprecedented disequilibria. Large and unsustainable current account imbalances across major economies were integral to the buildup of vulnerabilities in many asset markets. And in recent years, the international monetary system failed to promote timely and orderly economic adjustment. Now, this failure has ample precedence. Over the past century and a half, different international monetary regimes have struggled to adjust to structural changes, including the integration of emerging economies. In all cases, systemic countries failed to adapt domestic policies in a manner consistent with the monetary system of the day. And as a result, adjustment was delayed, vulnerabilities grew, and the reckoning, when it came, was disruptive. So policymakers must learn these lessons from history, and the G20 commitment made in the past few weeks in St. Andrews, Scotland, to promote strong, sustainable, and balanced growth in global demand is an important step in the right direction. So what I propose is to talk a bit about the international monetary system, how it should function. There will be a bit of history in that. Then talk about the current system and the strains in that system, and then move into potential solutions. So what is the international monetary system? Well, obviously it's exchange rate arrangements, capital flows, and a collection of institution rules and conventions that govern the operation. Domestic monetary policy frameworks dovetail and are essential to the operation of that system. A well-functioning system promotes economic growth and prosperity through the efficient allocation of resources, increased specialization in production based on comparative advantage, and the diversification of risk. It also encourages macroeconomic and financial stability by adjusting real exchange rates to shifts in trades and capital flows. To be effective, the international monetary system must deliver both sufficient nominal stability in exchange rate and domestic prices and timely adjustment to shocks and structural changes, and attaining that balance can be very difficult. Changes in geographic distribution of economic and political power, the globalization of goods and asset markets, wars, inconsistent monetary and fiscal policies all have the potential to undermine a given international system. Past systems could not incent systemic countries to adjust policies in a timely manner, and the question today is whether the current shock of integrating 1/3 of humanity into the global economy, clearly a positive shock, but the question is whether that shock will overwhelm the adjustment mechanisms of our current system. And there are reasons for concern. China's integration into the global economy alone represents a much bigger shock to the system than the emergence of the United States at the turn of the last century. China's share of global GDP has increased faster, and its economy is much more open than the U.S. As well, unlike the situation when the U.S. was on the gold standards, along with all other major economies, China's managed exchange rate regime today is distinct from the market-based floating rates of other major economies. And history shows that systems dominated by fixed or pegged exchange rates seldom cope well with major structural shocks. This failure is the result of two pervasive problems. First, an asymmetric adjustment process, and secondly, the downward rigidity of nominal prices and wages. In the short run, it is generally much less costly, economically as well as politically, for countries with a balance of payments surplus to run persistent surpluses and to accumulate reserves than it is for deficit countries to sustain deficits. And this is because the only limit on reserve accumulation is the ultimate impact on domestic prices, and that depends on the openness of the financial system and the degree of sterilization. And that can be delayed for some time. In contrast, deficit countries must either run down reserves or deflate. Flexible exchange rate regimes prevent many of these problems by providing less costly and more symmetric adjustment. Relative wages and prices can adjust quickly to shocks through nominal exchange rate movements in order to restore external balance. When the exchange rate floats and there's a liquid foreign exchange market, reserve holdings are seldom required, and most fundamentally, floating exchange rate regimes overcome the seemingly innate tendency of countries to delay adjustment. A brief review of how different international monetary regimes failed to manage this trade-off between nominal stability and timely adjustment provides some important insights, at least in my opinion, for current challenges. Under the classical gold standard, the international monetary system was largely decentralized and market-based. There was minimal institutional support apart from a joint commitment of the major economies to maintain the gold price of their currencies. Although the adjustment to external imbalances should, in theory, have been relatively smooth under the gold standard, in practice it was not problem-free. Surplus countries did not always abide by the conventions of the system and tried to frustrate the adjustment process by sterilizing gold inflows. On the other hand, deficit countries found the adjustment process even more difficult because of downward wage and price stickiness. Once shocks were large and persistent enough, the consequences of forfeiting monetary independence and asymmetric adjustment ultimately undermined the system. Consequence, the gold standard did not survive World War I intact. Widespread inflation caused by money finance war expenditures and major shifts in the composition of global economic power undermined pre-war gold parities. And so when countries such as the United Kingdom in 1925 tried to return to the gold standard at overvalued parities, they were forced to endure painful deflation of wages and prices in order to restore competitiveness. Though this was always going to be difficult, it proved impossible when surplus countries thwarted reflation. During the Great Depression, with an open capital account and a commitment to the gold exchange standard, the United States could not use monetary policy to offset economic contraction. Fidelity to gold meant that deflationary pressures from the U.S. spread quickly, further weakening the global economy. And unable to adjust to these pressures, countries were forced to abandon the system. Though deficit countries experienced the first crisis, all countries suffered from the eventual collapse, a lesson that was repeated in subsequent systems. The Bretton Woods system of pegged but adjustable exchange rates was a direct response to the instability of the interwar period. Bretton Woods was very different from the gold standard. It was more administered than market-based. Adjustment was coordinated through the IMF, or was supposed to be coordinated through the IMF. There were rules rather than conventions, and capital controls were widespread. Despite all of these institutional changes, surplus countries still resisted adjustment. Foreshadowing present problems, countries often sterilize the impact of surpluses on domestic money supply and prices. Like today, these interventions were justified by arguing that imbalances were temporary and that, in any event, surpluses were more evidence of virtue than disequilibria. In contrast, the zero bound on reserves remained a binding constraint for deficit countries, which eventually ran out of time. The Bretton Woods system finally collapsed in the early 1970s after the U.S. policy became very expansionary, its trade deficit unsustainable, and the loosening of capital controls began to put pressure on fixed exchange rates. Once again, all countries suffered from the aftershocks. After the breakdown of the Bretton Woods system, the international monetary system reverted to a more decentralized market-based model. Major countries floated their exchange rates, made their currencies convertible, and gradually liberalized capital flows. In recent years, several major emerging markets adopted similar policies after experiencing the difficulties of managing pegged exchange rate regimes with increasingly open capital accounts. The move to more market-determined exchange rates has increased the control of domestic monetary policy and inflation, accelerated the development of financial sectors, and ultimately boosted economic growth. Unfortunately, this trend has been far from universal. In many respects, the recent crisis represents a classic example of asymmetric adjustment. Some major economies have frustrated real exchange rate adjustments by accumulating enormous foreign reserves and sterilizing the inflows. While their initial objective was to self-insure against future crises, reserve accumulation soon outstripped these requirements. In some cases, persistent exchange rate intervention has served primarily to maintain undervalued exchange rates and promote export-led growth. Indeed, given the scale of its economic miracle, it is remarkable that China's real effective exchange rate has not appreciated since 1990. The flip side of these imbalances was a large current account deficit in the United States, a deficit which was reinforced by expansionary U.S. monetary and fiscal policies in the wake of the 2001 recession. In combination with high savings rates in East Asia, these policies generated large global imbalances and massive capital flows, creating the conundrum of very low long-term interest rates, which in turn helped feed the search for yield and excessive leverage. While concerns over global imbalances were frequently expressed in the run-up to the crisis, the international monetary system once again failed to promote the actions necessary to address the problem. Vulnerabilities simply grew until the breaking point. Now, some of these pressures remain. For example, the financial crisis could have long-lasting effects on the composition and rate of global economic growth. And since divergent growth and inflation prospects require different policy mixes, it is unlikely that monetary policy suitable for the United States will be appropriate for most other countries. However, these countries, with relatively fixed exchange rates and relatively open capital accounts, are acting as if it is. If this divergence in optimal monetary policy stance increases, the strains on the system will grow. Postponed adjustment will only serve to increase vulnerabilities. In the past, the frustration of adjustment by surplus countries has generated deflationary pressures on the rest of the world. Similarly, today, the adjustment burden is being shifted to others. Advanced countries, including Canada, Japan, and the euro area, have all recently seen sizable appreciations in their currencies. The net result of all of this could be a suboptimal global recovery in which the adjustment burden in those countries with large imbalances falls largely on domestic wages and prices rather than on nominal exchange rates. History suggests that this process could take years, repressing global output and welfare in the interim. So where do we go? To avoid these outcomes, there are several options. The first is to reduce, the first set of options, that is to reduce the overall demand for reserves. Alternative mechanisms for this include regional reserve pooling mechanisms such as Chiang Mai and enhanced lending and insurance facilities at the IMF. While there is merit in exploring IMF reforms, their effect on those systemic countries that already appear substantially overinsured would likely be marginal. And as I will touch on in a moment, the G20 process may have a greater impact. So that's the demand side. On the supply side, several alternative reserve assets have been suggested. And the motivation of these proposals is primarily to redistribute the so-called exorbitant privilege that accrues to the U.S. as the principal supplier of as the principal reserve currency. As the principal reserve currency, the United States receives an advantage in the form of lower financing costs and an ability to finance in its own currency. Now, with multiple reserve currencies, this advantage would be shared and possibly reduced in aggregate. In turn, this could marginally reduce the collective imbalances of reserve currency countries. Over the longer term, it is possible to envision a system with other reserve currencies in addition to the US dollar. However, with few alternatives ready to assume such a role, the US dollar can be expected to remain the principal reserve currency for the foreseeable future. Despite the exuberant pessimism reflected in the gold price, total gold stocks represent only $1 trillion, or about 10% of global reserves, and a much smaller proportion of global money supply. The renminbi's prospects are moot, absent convertibility in open capital markets, which would themselves likely do much to reduce any pressure for change. At first glance, special drawing rights of the IMF would be an intriguing alternative reserve asset. Using SDRs appeals to a sense of fairness in that no one country would enjoy the exorbitant privilege of reserve currency status. So like a multiple reserve currency system, using SDRs may reduce the aggregate incentives of countries that supply the constituent currencies of the SDR to run deficits. In addition, there appears to be no technical reason why the use of SDRs could not be expanded. However, the question must be asked, to what end? Merely enhancing the role of SDRs would do little to either increase the flexibility of the system or change the incentives of surplus countries. By providing a ready swap of existing reserve currencies into a broader basket, SDR reserves could also further displace adjustment onto other freely trading currencies, thus exacerbating the imbalances in the current system. Indeed, by providing instant diversification, SDR reserves could entrench some of the existing strategies of surplus countries. Now, this would change if the proposal were taken to its logical extreme, the SDR as a single global currency. Now, setting aside the rather large fact that the world is not an optimum currency area, not least to the absence of free mobility of labor, goods, and capital, that aspect would appear utopian. While the level of international cooperation has certainly increased since the crisis, it would be a stretch to assert that there's any appetite for the creation of an independent global central bank. As a result, any future SDR issuance is likely to be ad hoc. Greater use of SDRs might be best suited to encouraging a transition to a more stable international monetary system by facilitating any desired reserve diversification, by explicitly facilitating that. Establishing on a temporary basis an enhanced substitution account at the IMF would allow large reserve holders to exchange US dollar assets for SDR-denominated securities, thereby diversifying their portfolios. With the IMF bearing the risk of changes in the US dollar exchange rate, an appropriate burden-sharing arrangement amongst the members of the IMF would have to be agreed upon. Now, a substitution account, as I just described, would create considerable moral hazard since reserve holders would be tempted to engage in further accumulation. And in addition, a substitution account would not address the fundamental asymmetry of the adjustment process. Thus, it would appear essential that a substitution account mark the transition from the current hybrid system to an international system characterized by more flexible exchange rates for all systemic countries. In general, alternatives to the dollar as the reserve currency would not materially improve the functioning of the system, while reserve alternatives would increase pressure on the U.S. to adjust, since the artificial demand for the U.S. assets would be shared with others. Incentives for surplus countries that have thwarted adjustment would not change. And the common lesson of the gold standard of Bretton Woods and of the current hybrid system is that it's the adjustment mechanism, not the choice of reserve asset, that ultimately matters. With adjustments that would arise automatically from floating exchange rates or unsterilized intervention currently muted, the burden is squarely on policy dialogue and cooperation. And in this regard, there's some good news. The G20 framework announced in St. Andrews 2 weeks ago moves in the right direction. It stresses countries' shared responsibility to ensure that their policies support strong, sustainable, and balanced growth. Under the framework, G20 members have agreed to mutual assessment of their monetary, exchange rate, fiscal, and financial policies with the assistance of the IMF and other international financial institutions. The implications of these policies for the level and pattern of global growth and the risk to financial stability will be reviewed by finance ministers and governors in preparation for agreement on common actions by G20 leaders when they meet in Canada and South Korea next year. And there are several reasons why this mutual assessment process has the potential to develop shared understanding and encourage that action across a range of countries. First, there's a clear timetable. Secondly, there's a comprehensive set of policies that will be considered. In fact, all the relevant policies are on the table. Third, policymakers at the highest levels, up to the leaders level, are directly involved, and international financial institutions are serving a supportive rather than a leading role. And finally, the discussions will take place at the G20, where all major economies are present and where China and other leading emerging markets, but particularly China, has assumed a very constructive leadership role. Framework discussions would be also another reason for optimism, some optimism, is that framework discussions that I just described would be complemented by successful implementation of the G20 financial reform agenda. These reforms, when combined with the peer review process of the FSB and external review by the IMF, could increase actual and perceived systemic stability and thereby reduce reserve accumulation. So what's Canada's role in all of this? Well, we will bring to these discussions, in our opinion, one of the soundest financial systems, and JJ just validated that, so I will quote you on that, one of the soundest financial systems in the world, and a macroeconomic strategy that contributes to sustainable and balanced global growth. Our economy is one of the most open in the world, and our policy response to the crisis has been among the most aggressive. Starting from the strongest fiscal position in the G7, Canada's fiscal stimulus this year and next will total 4% of GDP. Our monetary stimulus has been both unprecedented and timely. As a result of these policy actions, the IMF projects that Canadian domestic demand, which is what's important for rebalancing, will be the strongest in the G7 next year. With a current account that has shifted from a 2% surplus in 2006 to a 3% deficit today, Canada is doing its part to rebalance global growth. Consistent with the objectives of the G20 framework, Canada's policy is guided by transparent and coherent frameworks. The Government of Canada has announced a fiscal plan to return its budget to broad balance by 2015. And the cornerstone of the bank's monetary policy framework is our inflation target, which aims to keep the annual rate of CPI inflation close to 2%. And it's in this context, in the context of the inflation target, that we view the exchange rate. A floating exchange rate is a central element of our monetary policy. It allows Canada to pursue an independent monetary policy appropriate to our own economic circumstances. Although there's no target for the Canadian dollar, the bank does care why the exchange rate moves and what the potential impact will be on output and inflation. The challenge for the bank is to understand the reasons behind currency movements, incorporate those into our assessments of other data, and set a course for monetary policy that works to keep total demand and supply in balance and inflation on target. In the current environment, such determinations are more important than usual. Recent indicators point to the start of a recovery in Canadian economic activity following 3 consecutive quarters of sharp contraction. This resumption of growth is supported by monetary and fiscal stimulus, increased household wealth, improving financial conditions, higher commodity prices, and stronger business and consumer confidence. However, heightened volatility and persistent strength in the Canadian dollar are working to slow growth and subdue inflation pressures. The current strength in our dollar is expected over time, to move to more than fully offset favorable developments since July. So on October 20th, in our last rate decision, the bank reaffirmed our conditional commitment to maintain our target for the overnight rate at its effective lower bound of 0.25% until the end of June 2010 in order to achieve the inflation target. So to put it simply, the bank looks at everything, including the exchange rate, through the prism of achieving that inflation target. For example, we do see a risk that a stronger than assumed Canadian dollar, driven by global portfolio movements out of U.S. dollar assets, could act as a significant further drag on growth and put additional downward pressure on inflation. As I mentioned previously, movements in currencies could reflect the current challenges in the operation of the international monetary system, which may result in the displacement of adjustment pressures onto a handful of currency. Whatever happens, the bank retains considerable flexibility in the conduct of monetary policy at low interest rates, consistent with the framework we published in April. So to conclude, the crisis was caused in part by failures to meet the same challenges that bedeviled previous international monetary systems. The common lesson of the gold standards of Bretton Woods and the current hybrid system is that it is the adjustment mechanism, not the choice of reserve asset, that ultimately matters. In this regard, any greater use of SDRs might be best suited to encouraging a transition from the current hybrid system to a system characterized by more flexible exchange rates for all systemic countries. While surplus countries can delay adjustment, in the end, all nations suffer when the system breaks down. In the current environment, growing strains could spur protectionism, both in trade and finance, or alternatively, raise sanctions. The negative consequences for the global economy of these actions would be considerable. In our opinion, all the countries should accept their responsibilities for promoting an open, flexible, and resilient international monetary system. Responsibility means recognizing spillover effects between economies and financial systems and working to mitigate those that could amplify adverse dynamics. It means submitting their financial policies to peer review within the FSB and external review by the IMF. And fundamentally, it means adopting current macro policies and allowing real exchange rates to adjust to achieve external balance over time. Indeed, in a world of global capital, all systemically important countries in common economic areas should move towards market-based exchange rates. Thank you very much for your attention, and I'd be happy to answer any questions.